This is the Cameron Journal Podcast. It's a place where we talk about important things. It's a place where we bring a little slice of the news to you. It's a place where we do important things, have important conversations. It's also things that I like to talk about. My name is Cameron Cowan, and this is the Cameron Journal Podcast. Today on the Cameron Journal Podcast, we are happy to welcome Noah Healy to the podcast. So this is very interesting. I have learned more, I think, about commodities markets than I ever wanted to know. Trying to understand what it is exactly Noah does. He is, and I quote, a recreational mathematician, which as a writer sounds like my idea and nightmare of hell. But I presume he has fun with it. And he has figured out a way to make markets more transparent and fair and less speculative and all this type of thing. And so we're going to dig into all of that. I imagine the discussion is going to be very thick. So strap in, folks. There's going to be a lot of numbers coming at us, and it's going to be frightening, but we'll get through it. Welcome, Noah, to the Cameron Journal Podcast.
Thank you, Cameron, for having me here. And I have to say that as a dyslexic, writing is my nightmare. So,
Well, see, we're both in our lane. We're both in our lane. You can have the numbers. I'll keep the words. We are in our lane.
There we go.
Yes, my dad is also dyslexic, and if he has an important email to write, my mother, who like me is linguistically gifted, has to read it first because, yeah, getting text from my dad is fun. It's like playing a guessing game. What did he really mean to say? Yes. So why don't you tell us a little bit about yourself and how you got into analyzing commodities markets? Let's begin from the beginning.
Sure. So it started out with a journey actually to think about different kinds of communication networks, and in particular, how to find consensus in a network communication scenario. So you have sensors or people or really any kinds of agents that have information or opinions or whatever sort of thing. How would you make sense of that from the computer perspective? One of the real challenges to using computers appropriately is that human beings have a very naturalistic attachment to procedure, where we can do things like sort cards into an order, or look up something in a dictionary in a way that is learned, but becomes sort of very natural and something that we don't think about. But computers, by and large, don't have that capacity. So if we want to carry out these types of actions, we have to figure out how to break them down and describe them in ways that might seem more pedantic than is even reasonable. So that's the problem I was working on. Like, how would you take a disparate set of measurements, opinions, and collect a common consensus out of that system? And the approach that I came up with for doing that was fairly novel. And again, on a lark, I decided to see if I could turn that into a marketplace by essentially turning the algorithm back on itself. In computer speak, this is called recursion, when a function or a system refers back to itself in its operation. And it greatly increases the complexity of a system to have it recurse in a way that doesn't behave what's termed psychotically, actually. Uh, and so that was it. It was just a challenge in recreational math. And once I had done that and had that system and was analyzing it for what properties it had, that's when it started to become quite clear that what I had actually done was found a marketplace model that has a lot of superior features to the markets that we're using these days.
All right. So I'm going to say some things and we'll see how close I was having just heard what you said. So,
Okay.
top line is computers are bad at sorting information that's not kind of already pre-filtered around certain parameters, and you have come up with a way mathematically not only to solve that problem but incentivize people who contribute to the market rather than detract from it.
Yeah. So that second part is you're getting ahead. You've sort of looked in the back of the book at the answers a little. I know. Um, what that the reason my system works better than the existing system is that uh, because of that pedantic, sort of very tight description of activities, it's easier in my market design to separate helpful from unhelpful speculative action, which allows us to reward the helpful action more than current markets reward it, and punish unhelpful action more than current markets punish unhelpful actions.
All right. Now, in any market, you have to have people who are benefiting. And one hopes that both sides of a transaction benefits. You have bread, I have money, I give you money, I get bread.
Yeah.
Happiness. When you scale that up to things like commodities trading, um, you have you have parties who are making bets on the actions of others and trying to make money off the activity of other people. So you kind of have this third person looking to benefit in the market. Under your system, who's benefiting from your new market arrangement?
So I have three roles to play within the market, and each of them has a benefit over the current role that they play within the marketplace. Um, those three roles are producer, consumer, and forecaster. The producer will be receiving higher prices because the lower overhead cost of my market goes straight to their bottom line. The consumer uh, is more of a medium to long term benefit, but what they're going to see is ultimately greater production and lowered prices, because as production becomes more profitable, more people will move into making bread. And then, with bread being more plentiful, it will become cheaper. And then finally, the forecaster, because my system can tell the difference between helpful and unhelpful forecasters, the helpful forecaster receives a higher rate of return on their investments than than forecasters have hitherto seen.
Okay. Now, let's keep with our bread analogy before I shift to something like bread fuel, like jet fuel, rather.
Right, sure.
Um, Farm commodities prices are very manipulated, mostly by government. Most people don't know that. It's been happening since the Great Depression. The government supports commodity prices to keep farmers in business,
Absolutely.
by paying farmers not to grow things, by paying other farmers to grow things. Too much milk, dump 10 million gallons of it, all this type of thing.
Correct.
How does government subsidy come into your market system?
It's effectively irrelevant to the market system because the purpose of a market system is to discover the price at which supply and demand will match one another. If there's a exogenous form of demand, if the government basically like, we want to jack up the price of bread, so tell you what, we're going to buy a third of the wheat crop and burn it on 4th of July for celebrations. Well, that restriction of the amount of wheat will jack up the bread prices, um, and and that will encourage more wheat production as a result of doing that. If a government were doing or were going to do that, then a functioning marketplace would recognize that that was going on and find prices that still caused supply and demand to match up, including this exogenous, 25% demand for large Fourth of July bonfires. And while that example is somewhat facetious, our government, of course, has ethanol subsidies where it quite literally buys up corn or subsidizes the buying up of corn to be turned into ethanol, which then gets burned up in our cars' gas tanks.
Yes, and I'm so glad you. Yes, so a couple things. One is I feel like, and I'm not going to say I think because I don't have clear thinking on any of this. I feel that's genuine. I feel like commodities prices under your system would be less stable because you would end up with all this incentive to grow a lot more of something at whatever price is high or whatever futures contract can be secured rather than focusing on a diverse amount of things in so much as if prices, so for example, if the price of wheat is high, the corn farmer might say, screw corn, wheat's the better idea. We end up with less corn. The price of wheat goes down, the price of corn goes up. Bad for the wheat farmers, good for the corn farmers. So great for Kansas, bad for Iowa. And and the consumer has lower bread prices and higher fuel prices, higher everything that uses high fructose corn syrup.
So the thing to understand is that the forecasters are trying to achieve a marketplace that is doing as much as it can. So destabilizing a marketplace is actually losing them money. So if they were to do something like you're talking about and sort of jerk production around, what they would be doing is redirecting farms that were better at producing wheat into producing corn, say. And as a result of doing that, uh, the 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 total production value of everything that was made would actually go down. and because uh, their returns are proportional to the total value being pushed through the marketplace, that would lose them money. So it's actually directly counter to their interests to cause the kind of disruption that you are describing. Intertemporal disruption is even worse. If you were to create a spike in prices in the future, you would effectively destroy both supply and demand, um, because with an oncoming price spike, the sellers would be unwilling to sell, because why wouldn't they wait for the price spike to occur? Uh, and well, buyers would be desperate to buy once the spike actually occurs. Because it's a spike, they will be unwilling to buy. And so what you wind up with is essentially two broken marketplaces. And so what my system does when forecasters find themselves having painted themselves into a corner like this somehow, um, it takes that reduction in deal flow and readjusts itself and makes it more less expensive to speculate. And so unstable markets encourage new blood to come in and stabilize them.
Okay. Um, this is a good transition then, because I want to look at something that the government doesn't manipulate as much, something like jet fuel, something where futures contracts are very important and the airlines sell them to each other. So, under the current system, Delta will buy futures contracts on Jet A at a low price in the winter so that they save on fuel costs in the height of the summer. United over here didn't buy so many contracts. And Delta says, well, I'm sitting on several and we're not going to need all that jet fuel. So I'll sell you these futures contracts. You can, you lower your fuel costs. Delta makes some money. United gets lower fuel costs. Everybody happy. The oil still gets produced, refined, turned into Jet A, sent to an airport, planes fly. And those prices are set based upon, you know, historical demand. Everybody knows more people fly in the summer than over the winter. And so there's demand starts peaking in May, goes through June, July, August, falls off in September.
Yeah.
So we all know that this is that, and everybody in the market knows that this is going to happen. So that's how the market works today. Under your system, how would Delta and United be able to secure jet fuel at lower prices, knowing that they're going to be needing a lot of it very consistently at a very specific time of the year?
So effectively what occurs, well, let me divide this out into two steps. The first one is it's relatively difficult to predict exactly how my marketplace will perform in a given scenario because it's smarter than I am, because it acts with the collective intelligence of all of the participants in the marketplace, and lots of brains are sort of better than one. There are effectively two reasonable strategies that such a marketplace could take on, that I can think of. The first one would be functionally stabilizing prices across the time window. So right now, we see a fairly strong supply demand shift that's underpinning what's actually going on, which is a combination of productivity shifts and storage, and that's how those deals are actually mediated. Um, we could see prices actually relatively stabilize season over season and replace that function, say allowing the airlines to economically buy storage uh, uh, of their own and simply pre-buy jet fuel and store it uh, as part of their operations. The secondary, excuse me, the second strategy that might be reasonable under those circumstances is that because my system is calculating a price curve, uh, it might be the case uh, for that marketplace that effectively making deals ahead of time is as good as it gets. And so the market would exist. Most deals would actually take place, 3 to 6 months in the future. And that's simply how that marketplace would function. However, the most likely outcome is that the the stabilization force and predictive force would be strong enough that um, since the buyers are buying at that good price is in fact, or whatever the actual sort of outcome price of their buying is the actual sale price, and the apparent high prices being produced by the existing marketplaces, which somehow are not being acted upon by the buyers, are effectively just a noise artifact of the existing market structure. And in that case, what we would see is a extreme stabilization of the price, which everyone would be able to directly participate in. And the large players would simply be able to fire their hedging departments as unnecessary because the marketplace would effectively be hedging for them.
Oh, okay. Okay. That's several interesting scenarios of what could happen. The idea of airlines owning their own Jet A storage on a mass scale is interesting. Um,
It's a possibility. I mean,
yeah.
effectively, that has to be going on behind the scenes, and whether it would be effectively whatever the most economical course of action for the market as a whole is what would be selected for, because whatever's most economical is what's going to make each individual the most money.
Right. So, another good idea. um Derivatives and speculation. Your market discourages that. In this sort of market, would it behoove me to take a long position? I'm trying to think of if I'm going to use this example right. Would it behoove me to take a long position on jet fuel prices in order to make money on the price fluctuations over time?
So I'm pretty sure the answer to that is no. Um, so my system doesn't just discourage uh, options trading or futures trading. It actually develops an information source which and then publishes it. And that information source makes futures and options trading uh, a money losing proposition to offer. Um, so the
Okay. Let hang on a second. Let's unpack that. That's a lot. Let's
yeah
unpack that for a second, because let's for the listener and honestly for me as well. So, right now we know from our example, Delta buys oil Jet A contracts 3 to 6 months in advance of when they want delivery of the Jet A to their airports for their airplanes.
right.
Um, and so under your market, would Delta still be buying futures contracts on Jet A, or would they have an office whose daily job it is to buy fuel on the marketplace to make sure their planes fly?
They'd be more likely to be doing the second thing. Um,
So there would be an office of gas in Atlanta, 20 people buying Jet A, like
yeah,
on
yeah,
computers
basically.
like a boiler room. Yeah.
Yeah, yeah. Except there'd just be the market. You'd just put in your order. It would fill up, and then you'd take it. You'd take delivery. Uh, so it'd be mostly a logistics question. So the thing about that
I mean,
that
but
deep.
that could get. I'm so sorry to interrupt you again.
Oh yeah,
That could get so. I feel like I agree with you. I feel like that's like a logistics problem because pipelines. Most Jet A is not delivered by truck; it's actually delivered by pipeline, particularly
yeah.
at very large airports. Hartsfield Jackson, SeaTac, Denver, any of the airports in New York,
That makes sense
LAX.
today.
Yes, all comes by pipeline. I feel like in your marketplace, it would be financially efficient to buy fuel an hour before a plane takes off. Think of this scenario. We're at our office of gasoline in Atlanta for Delta, and we have a flight leaving at 3 o'clock. Under your system, it could be financially efficient to buy the Jet A for that plane at 2 o'clock when the
Uh,
crew is walking on to do pre-flight check. But then how do we get the fuel to the plane on time?
well,
I
if
feel like
it's
that's kind of the barrier because it
right,
would be
well,
efficient to do it in the moment, but maybe not logistically practical to do it in the moment. Does that make any
the
sense?
right. So my system depends on pricing at a pace that matches the logistical practicalities. So something like electricity could be traded every few minutes. And in fact, electricity is traded on, I think, 15-minute time windows.
Hello,
Uh,
Enron.
yeah. Uh, but for something like jet fuel to enjoy that kind of thing, the pipelining would have to be at an efficiency level that made that practical. And while, as you say, for certain major airports, that might be the case, I don't know that those airports would have a a large enough draw to support a market just for that airport. So consequently, I think they'd still be more or less stuck with having a logistics department that works out what's going on and matching up the their operational tempo with the logistical delivery tempo that exists for fuel. But that could easily be a once a day computation where effectively each day you buy the fuel you're going to use tomorrow, um, and then maintain a bit of a reserve to cope with the normal hurly burly of life and whatnot. Um, and such a system is conceivable. I'm not enough of an expert to say whether or not that's where it would get to. Um, However, the the futures contract that they currently buy is being offered on a marketplace in which their counterparty is under the impression that that the counterparties can be making money by offering this contract to them. Um, and in fact, on average, the counterparties are making money because most of the counterparties in the markets are these middle man hedge fund people who are experts on the marketplace that are not in the business of going out of business. And so the the price curve that a coordinated discovery, my system CDM develops, creates a pricing model for where the collective wisdom thinks that the market is heading, and that collective wisdom would naturally exceed the the individual wisdom of any sub part of the marketplace, which means that if a CDM existed in jet fuel and the the carriers basically took that information and attempted to get deals as good as what the CDM was offering through the existing marketplace, their counterparties would be losing money on those deals, and so would either be not show up and no market would exist, or if somehow some external subsidy showed up, somebody would have to be priming the pump and basically pumping money into the customers' pockets in order to get them to keep playing. And since really nobody has an infinite money spigot, whoever was doing that would eventually run out. Although, depending on who they were, that would look different. A private individual would go bankrupt very rapidly. Something like the Fed would simply cause hyperinflation.
Right. So now, we were talking about options and all this type of thing, it does not. So in this marketplace, it doesn't behoove me to bet on the future prices of jet fuel because the discovery model has enough information on all sides that, as you said, the wisdom of the market trumps the wisdom of the individual. So the speculators are basically put out of business because there's really no place for them in your new CDM.
No, there is a place for them. There's a place for them in my price discovery model where they put their speculations into the system, and those speculations are integrated with everybody else's speculations by measuring how much information is in each proposition. And that system is what is creating this better pricing knowledge by combining everybody's impressions into a system that is explicitly attempting to be as low noise as possible.
Okay, that that makes some sense. Does this market work outside of commodities?
That would be difficult.
Because when I was watching your video, I was thinking this would ruin equity and bond markets.
The difficulty,
like, don't dare do this to stocks and bonds because, oh my goodness, that would just be a disaster.
The difficulty with applying them to equity and most bond markets is that this is taking advantage of the distinct nature of producers and consumers. So right. You have this large population of people that, say, pull oil out of the ground and refine it, and this other large population of people who fly airplanes, and they need to find each other at some kind of price point and make deals. So they have a common interest in finding that common price and are willing, because they're already doing this, to pay people to do that for them. So those interests are all aligned. However, the stock market does not composed of these gnomes that live under the underground in New York and are just like churning out stock certificates every day, and this other vast group of say retirees in Florida that eat stock certificates for a living. Like the people,
That's good. That's good.
right? People are buying and selling these things at the same time, and the stock is mostly recirculating. And so stabilizing the price, sure, that's fine. But in some sense, Warren Buffett is a value investor. He will only buy something that he believes is currently costs less than the underlying value of the company. Um, if if the marketplace were to accurately reflect underlying values at all times, not only would it stop moving and consequently stop functioning, but value investors would never buy anything ever, because everything would cost exactly what they think it's supposed to cost.
Well, I mean,
Uh,
that's yeah, I mean, that's my point. Is why I said I think it would destroy equities and bond markets because equities markets are all predicated on earnings multiples and future value and return to investors. So if something's trading at 17 times, earnings, and I think earnings are heading higher, and I think it'll go up to 24 times earnings, I'm going to buy the stock and then sell it when it gets to the right PE ratio. Like,
right,
okay, cool. That's the basics of equities trading, everyone. Bonds are similar, only it has nothing to do with future value. It has everything to do with the value of the debt underlying. Um, that's fine. I mean, yes, I think equities and bond markets would stop because if equities were trading at the price, if every company was traded at the proper price for its earnings of the present, then it would just become a speculation of basically the stock market would become one giant pump and dump scheme,
right.
basically.
There are parts of that system that might work out well under this circumstance. So things like the euro dollar market, where other countries trade in dollar denominated substances and then buy buy dollars in order to do those trades. That has some of the characteristics of a general commodity. Um, Sovereign bonds, most sovereign countries, particularly very highly rated sovereign countries, don't rebuy their own debt. And so a initial issuance CDM for their debt bonds could be something that would be in their interest. And conceivably, some sort of CDM-like system for handling IPOs and sort of founder equity type situations would have that kind of supply demand relationship that would be exploitable. But those are fairly advanced topics, and I'm really kind of sticking to these sort of simple types of financial situations.
Yeah, no, I think your market definitely makes more sense for commodities than it does anything and everything else. The one sticky point I see is that ultimately over in commodities, the bread company needs wheat to make bread. The airlines need fuel to fly. Ethanol people need corn to make ethanol. It seems to me there could be some difficulty in making sure that everybody gets the stuff that they want and they don't end up kind of panic buying and pressing the price higher because we're not going to have jet fuel tomorrow. We're not going to have wheat for production, all this type of thing. I feel like that could become so like what do you think that scenario looks like? Like how do we make sure that everybody gets what they need when they need it at the appropriate time for it to arrive?
So that gets into the settlement criteria, which is one of the tricky things about my system because I don't use either price or time priority in order to aggregate as many producers and consumers as possible into a group. Um, and in fact, it's that aggregation which is the source of my supply security. So you aren't so much necessarily concerned about the performance of your counterparty, you're concerned about the performance of your counter market. And if they can't come up to snuff, then really nothing ever could. Um, and we've seen that situation. When the Suez Canal got blocked up, many deliveries were not made to Europe on time because it was not physically possible to deliver things that were still in the Indian Ocean and couldn't get through the Suez Canal. Um, those sorts of situations can and will happen. Um, and I think that as exceptional as they are likely to be, they should be best handled in the way that they're presently handled, which is through insurance, effectively. You know, act of God or other types of large scale disruption. Companies that are worried about things like that, and many are and have a right to be, don't deal with them through the marketplace. They deal with them through insurance. In terms of the market, what my market does is it fills orders bottom up. And so what this does is it means that small or average sized orders are effectively guaranteed to fill, unless there's a really, really serious derangement in supply and demand. Um, and even large orders will at least partially fill. And what this does, in contrast to existing markets, is actually encourage a competitive supply space of buyers and sellers. Because in order to become large, you actually have to be able to have better unit economics than your small players. You can't sort of depend on being able to use muscle in the market to get you over that hump. Um, and that that encouragement of greater diverse competition over, again, this is a medium to long term solution, but that will actually encourage greater market stability, because the primary source that we see of heavy instability in current markets is because these markets are dominated by only a few players. And so when one of them, messes up, suddenly everything's out of balance.
Yes. I can see that. I get that. I think it's interesting. This point is interesting on how the amount of the amount that you're buying in the market, which is essentially an increase in demand, is muted this way, so that you can't force up prices or force down prices by how much you are or are not buying. I think that's interesting.
Yeah. So let's say for some reason I wanted to corner the jet fuel market. Um, right now, I could just start buying, and I'm not that rich, so I'd run out of money. But I could just start buying and jack the price up. In a CDM, I could go in as a forecaster and start bidding prices higher. But I'd have to show everybody that I was doing that ahead of time and allow them to adjust to what's going on. If I just show up and say, oh, yeah, I want to buy 10 times what I bought yesterday, then when the market sort of settles out, my share will probably be about the same size as my order was yesterday. The extra 9x isn't there. And everybody would get to see that and say, oh, it looks like the market was out of whack. If prices, were higher and there was more supply or less demand, then we would be able to fill this. let's start jacking up prices. So whereas right now you can buy in, jack prices up, and then maybe sell off at those high prices that you've produced. Or in the case of shorts, you can sort of sell off and drop prices and then maybe buy in at those low prices that you've produced. In the CDM system, if you want to do some manipulative thing like that, you have to raise or lower the prices first, and then you bear the brunt of the costs that you're imposing on the marketplace in general. And because that isn't economic, that could only be pursued for what are criminal reasons. And because it's very obvious that it's going on, that kind of thing would be swiftly punished.
Right, right. So I think that's the difficulty I see at some level is that if the government wants to keep agricultural commodity prices higher or lower, there's no real way for them to do that anymore.
Well,
I
there
presume because the market is now self regulating and we would need those subsidies. That's my presumption.
no, no. So there is a way for them to continue to do that, and it's the way we were talking about before. They would have to enter in a as a buyer or seller. So if they wanted to artificially jack up the price of, you know, substance X, they could just announce that we're going to buy, 50,000 tons of substance X, no matter what the price is. Um, because there's that extra demand always present, there's now an interest in jacking prices up. And in fact, if they were dumb enough to do that, the price of substance X would go to the sky. Because if the government's going to buy 50,000 tons, no matter what it is, then the maximum value of that marketplace would be driving the price so absurdly high that everyone else is just driven out of the marketplace. But, you know, the market, the government's buying wheat for like gold money, and suddenly it's a whole new ball game. Um,
Yeah. I mean, I mean, I think that's part of the difficulty is, there's um,
well,
a finite
so
amount of things, only so
I
much wheat
think
is produced, only so much oil,
right. I think we need to distinguish between the government's capacity to change market prices in ways that it wants to, and the government's capacity to alter the economy to cause it to become more productive. The first thing is fairly easy for them to do, and CDM will not interfere with their capacity to do that. The second thing is extraordinarily difficult to do, and CDM will at least ameliorate the damage that they do by interfering with the marketplace by coming up with insane proclamations like that. But only so much. The uh, great trauma surgeons can do a lot, but at a certain point, that if it's DOA, it's DOA, and there's nothing you can do anymore.
Yeah. No, that is certainly true. So, well, we're coming up to the top of the hour. This has been fascinating. My mind is full. I am speechless. I will be thinking about this for hours. Ever since the great financial crisis, I have been a student of markets and financialization and all this sort of thing. So this is when it comes to how markets do and do not function and all this type of thing. That's a big part of what I have studied and learned and what I cover in the business part of the Cameron Journal and all this type of thing. Um, so, absolutely fascinating. This is the part of the show where we ask people where people can find you online and stay in touch with you. I'm sure I have one or two math nerds that are going to want to be in touch. They got to be out there somewhere.
Yeah. We're all over the place actually. So certainly, there's a website, coordisc.com, COORDISC. You can also find me on LinkedIn. I'm Noah Healy there, or you could drop me an email at noahphealy@yahoo.com.
Excellent, excellent. Well, thank you so much for coming on the Cameron Journal podcast.
Thank you for having me.
That's all for this episode of the Cameron Journal podcast. Thank you so much for listening. Visit us online at CameronJournal.com. We're on Facebook, Twitter, and Instagram, and I love to talk to my followers and listeners, so please feel free to get us on social media at Cameron Cowan on Twitter, and we'll see you next time on the Cameron Journal podcast.